Hi, my name is Riza. I'm an MBA student at IPMI International Business School, and welcome to Lessons Learned from Prof. Sembel's Corporate Finance class.
Lessons learned from corporate finance class. Last week was a little bit confusing but exciting as well. We mainly discussed about portfolio investments, where several new terms and concepts were introduced by Prof. Sembel. In the session, we dove deeper into how to assess a company's health using DuPont analysis, what and how to interpret the correlation between two stocks, what is capital asset pricing model, and how to use it, and how to strategize your personal financial plan. So let's recap all of that in brief. All right. So, DuPont analysis decomposed the different drivers of ROE or return on equity into three major financial metrics: net profit margin, asset turnover, and equity multiplier. We use this analysis to assess whether a company is healthy or not, in comparison to its benchmark company or the industry in general. This analysis allows investors to determine what financial activities are contributing the most to the changes in ROE, and to an extent, also allow them to consider whether to invest in the company or not. Next, a correlation between two stocks. Correlation in the finance and investment industries is a statistic that measures the degree to which two securities or a stock with a benchmark index move in relation to each other. It has the value between -1 and +1. A perfect positive correlation means that the correlation coefficient is exactly 1. When one security moves either up or down, the other security moves in the same direction. And contrary to that, a perfect negative correlation means that two assets move in opposite directions, and while a zero correlation implies that there's no linear relationship at all. Next, capital asset pricing model, or CAPM. CAPM describes the relationship between systematic risk and expected return for assets, particularly stocks. CAPM is widely used throughout finance for pricing risky securities and generating expected returns for assets, given the risk of those assets and cost of capital. And let's take a look at the formula here. Expected return of investment equals risk-free rate plus the beta of the investment multiplied by market risk premium, which is the expected return of the market minus the risk-free rate. In Indonesia, the average risk-free rate is approximately 5%, following the government bonds yield, while the MRP is approximately 10%, 8% following the US, and 2%, which came from the difference between the investment grade Indonesia, BBB, and investment grade in the US, AAA. Next, the personal financial plan. Basically, the principle is SAINS. Save and invest, then spend. For short-term to medium-term investing, you can go to reksadana terproteksi. And for long-term investing, you can go to reksadana saham, which is more volatile than the other reksadana, and so on and so forth.
So, those are the lessons learned from last week. Thank you all for watching. I'll see you all again next week. Cheers!